In the early 2000s, America had a fever, and the only prescription was apparently cheap money. After the dot-com bubble burst and 9/11 happened, the Federal Reserve, led by Alan Greenspan, decided the best way to keep the economy humming was to slash interest rates down to practically nothing. This made borrowing money incredibly easy. It was the national equivalent of putting everything on a credit card with a 1% introductory APR. The main beneficiary of this easy credit? The housing market, because nothing screams stable economy like convincing everyone, and I mean everyone, that they should own a house. Banks, once quaint institutions that asked pesky questions like, "Can you actually pay this back?" got creative. They invented the subprime mortgage, a wonderful product for people with shaky credit. The sales pitch was simple. Sign here, low initial payments, don't worry about the rate adjusting later, it'll be fine. The American dream was no longer something you saved for, it was something you financed with a ticking time bomb attached. So now Wall Street had mountains of these mortgages. What do you do with thousands of IOUs from people who might not pay you back? You could hold on to them and pray, or if you're a financial genius from the 2000s, you bundle them together into something called a mortgage-backed security, or MBS. Think of it like a fruitcake, a bunch of different, questionable ingredients all mashed together and sold as a single festive brick. But they didn't stop there. They took the riskiest slices of different MBS fruitcakes and baked them into an even more exotic dessert, the collateralized debt obligation, or CDO. This process, called securitization, was hailed as brilliant. It supposedly spread the risk so thin that it practically disappeared. They sliced these CDOs into layers, or tranches, and claimed the top layers were so safe they were practically government bonds. This was the financial equivalent of building a skyscraper out of Jell-O and insisting the penthouse was structurally sound. Now, how do you convince someone to buy your Jell-O skyscraper? You get an inspector to certify it. In the financial world, these inspectors were the credit rating agencies, Moody's, Standard & Poor's, and Fitch. Their entire job was to analyze investments and assign them a grade, from a super safe AAA to a junk level D. For decades, a AAA rating was reserved for the most stable entities on Earth, like the US government. Suddenly, in the mid-2000s, these complex CDOs, packed with subprime mortgages from people with 3 maxed-out credit cards and a job of unspecified consulting, were also getting AAA ratings. Why? Because the banks paid the rating agencies for each rating. It's a fantastic business model if you have no soul. The agency that gave the most favorable ratings got the most business. It's like letting students grade their own exams, but the exams are financial instruments that could detonate the global economy. With all this officially certified safe debt floating around, a new market emerged for the truly cynical. It was called the Credit Default Swap, or CDS. A CDS is basically an insurance policy. You could buy a CDS on a CDO, and if that CDO failed, the seller of the CDS had to pay you. The beautiful, and by beautiful I mean horrifying part, was that you didn't even have to own the CDO to buy insurance on it. This is like taking out a fire insurance policy on your neighbor's house. You're not protecting your asset, you're actively betting it will burn down. The biggest seller of these policies was an insurance giant called AIG. They sold hundreds of billions of dollars worth of these swaps, collecting massive premiums and assuming the risk was zero, because, after all, the housing market never goes down, right? Meanwhile, a few weirdos like Michael Burry were looking at the actual mortgages inside these CDOs and realizing they were garbage. So they started buying CDSs by the truckload, making a massive bet that the entire system was about to collapse. By 2006, the inevitable happened. The low introductory teaser rates on all those subprime mortgages started to reset. Suddenly, monthly payments ballooned. People who could barely afford the first payment were now facing bills that were double or triple the original amount. The foreclosures began, not as a trickle, but as a flood. This created a feedback loop from hell. More foreclosures meant more houses for sale, which pushed prices down. Falling prices meant more homeowners were underwater, owing more on their mortgage than their house was worth. Many just walked away, mailing their keys to the bank. All those safe, AAA-rated CDOs, their value evaporated because the monthly mortgage payments that were supposed to be flowing into them had stopped. In March 2008, the investment bank Bear Stearns, which was heavily invested in this junk, collapsed and had to be sold for pennies on the dollar in a shotgun wedding arranged by the Fed. This was the first major tremor before the earthquake. If Bear Stearns was a tremor, September 2008 was the planet cracking in half. The U.S. government stepped in to nationalize the two mortgage giants, Fannie Mae and Freddie Mac, because they were about to implode. Then came Lehman Brothers, the fourth largest investment bank in the country. It was teetering on the edge, holding billions in toxic assets. The government, led by Treasury Secretary Hank Paulson, decided to make an example of them. They wanted to teach Wall Street a lesson about moral hazard, the idea that you shouldn't get bailed out for your own stupid risks. So on September 15, 2008, they let Lehman Brothers file for bankruptcy. It was the largest bankruptcy in U.S. history, and the lesson it taught was that if you set off a nuke in the middle of a city to prove a point, you also blow up the city. Global credit markets froze instantly. No one knew who was solvent. The next day, AIG, the company that had insured all this trash, told the government it needed $85 billion by tomorrow, or it would fail, bringing the entire global financial system down with it. The Lehman decision was a catastrophic miscalculation. The lesson on moral hazard lasted about 24 hours before pure, unadulterated panic took over. The government, which just let Lehman die, immediately turned around and gave AIG a loan for $85 billion, which would eventually swell to over $182 billion. The hypocrisy was breathtaking. Then Hank Paulson and Fed Chair Ben Bernanke went to Congress and, in a scene that belongs in a disaster movie, essentially said, "Give us $700 billion, no questions asked, or the entire economy will cease to exist by Monday." This became the Troubled Asset Relief Program, or TARP. The first vote failed, and the stock market had its worst single-day point drop in history. After some frantic arm twisting, it passed. The government started pumping billions into the very same banks that created the crisis. It was like calling the fire department, and they show up to give the arsonist a golden fire hose and a medal. The bailout stopped the immediate freefall, but the damage was done. The Great Recession had begun. Millions lost their jobs, their homes, and their savings. The global economy was crippled for years. And the perpetrators? The architects of this meltdown? Almost no one went to jail. The banks that were too big to fail in 2008 are even bigger today. We got the Dodd-Frank Act in 2010, a massive piece of legislation designed to rein in Wall Street's worst impulses. It was a good attempt, filled with rules about capital requirements and derivatives trading. Many of its key provisions have been steadily watered down over the years, because the memory of financial apocalypse apparently fades faster than a politician's promise. The core machinery that created the crisis still exists. So we propped up the system, patched a few holes, and mostly just hoped for the best. Humans have a fantastic capacity for forgetting just how badly they can mess things up, especially when there's money to be made. If you enjoyed this video, please like, comment, and subscribe to our channel for more historical insights. Thanks for watching, nerds!